Welcome back to Market on Close. I'm Marley, Kayden. Our earnings coverage continues now with Carvana and ARM Holdings. Carvana shares up about 14% right now, climbing after their revenue topped estimates. I want to bring George Tsilis into the conversation here, our senior markets correspondent, for more on our earnings. You know, George, Carvana was supposed to deliver, and it sure looks like they did.
They did. I think the context of what happened with the tariff scare in Q1 really helped Carvana, to be honest with you, Marley, because vehicle prices, at least on wholesale and even retail used markets, rose as a function of expected tariffs, and that certainly manifested into some pretty robust top-line sales and EPS figures for Carvana as they reported this most recent quarter. But nonetheless, they did come ahead of estimates when it comes down to top-line sales at $4.84 billion. That was about 42% higher than last year at $3.41 billion. So that beat the estimates, which was 4.58. I didn't actually look at the EPS number, but they did report, and this is really important because they reported a net income. This is, again, dollars and cents, $308 million. Which is pretty significant considering that all of the last 4 quarters prior to the report for the upcoming quarter they just reported, they generated $400 million. So they basically generated 3/4 of an entire year's EPS in 1 quarter. So obviously this has been a great quarter for Carvana. Really big reaction in the after hours, plus 10%, over $50 per share right now. But they also reported metrics, net income margin numbers, 6.4%. Again, very important considering about 2.5% in the trailing 4 quarters prior to the one reported, and even operating metrics higher by a considerable amount with metrics on a margin basis over 10%.
You know, and the EPS number was $1.28, so well above that $1.10 that was expected. Yep. You know, as I'm looking through this report, you know, a record quarter for sales for used vehicles for them, and also saying that loan sales accounted for $274 million of its $308 million in profit this quarter.
Yeah, definitely. I think the aspects of Carvana, to be honest with you, Marley, has been really accretive towards vertical integration. You have to think about, you know, Vroom and Shift. These were a couple of names post-pandemic that went under. Carvana has become a mainstay player in the wholesale markets alongside CarMax, Lithia Motors, if you will, and AutoNation. And the volume growth has been tremendous, plus the acquisition of ADESA, which basically locks them into the wholesale auction market, has been very accretive. Not to mention insurance sales and financing, adding to the additional revenues that the company's generating without much additional cost. I think that's really indicative of why the company's profitability has expanded quite a bit. And even, you know, looking at this particular quarter's top line sales number, they're nearly at around $18 billion annualized sales number now, with $300 million on a quarterly basis in net income. So they've been increasing their profitability alongside top line sales growth. And I know there's a lot of bears against this, but whatever Carvana did to do what they're doing right now, they've done extremely well in terms of their strategy and their business plan.
You know, and now I want to transition to ARM Holdings, which also just came out. Their fiscal first quarter came in at 35 cents per share. That was down from 40 cents a year earlier. You know, and as I'm looking at, you know, what was expected for them, this one's not looking as good. You know, that was supposed to be 35 cents. So they're right in line there, but the market doesn't like it. Down about 5% here. As far as revenue goes, though, they did rise to $1.05 billion from $939 million a year ago. That was in line with estimates as well, but the street's disappointed by this one.
It is, and I think if you look at ARM, first off, you know, their CPU architecture is used by about 99% of mobile handsets globally. But I think the challenge for the business has maybe been some of the other computer infrastructure markets, data center markets. They've had trouble actually breaching into that and grow their market share. IoT and automotive also has been a challenge, and that might be reflective of what we're seeing in these numbers. But nonetheless, you know, the pretty much in line EPS, just a marginal decrease versus the estimates. I have 1.055 billion was the estimate that came in at 1.053, so just a fractional miss. And so that's enough to cause a little bit of slippage in the stock price. And then if you look at the guidance range, 1.1 to 1.11, so let's just split the difference at 105. Midpoint was pretty much in line, but it looks like there may be a slight widening out of the range on the EPS guidance for next quarter. Because if you think about this, they were expected to report 35 cents. They did this quarter, and next quarter still same 35 cents. So no sequential growth quarter over quarter, but they actually widen out the range now to 29 to 37 cents. So that puts the midpoint around 33 cents, which is lower by 2 cents than this quarter, but also the previous estimate for next quarter as well.
And are there any other numbers in this report, George, that are sticking out to you? You know, as I'm tracking their chart, you know, they're just trending down, now down more than 5%.
Well, I haven't seen the breakdown. I think the conference call and the revenue breakdown will give us more information in terms of what was the culprit in terms of the EPS revision down for next quarter. I suggest that maybe, you know, the consumer electronics space might be a little bit challenged. Maybe the automotive space is still kind of gray for them in terms of their business. But the other thing is the aspects of what's going on with R&D, I think, is important also. This is what I suggest, and also going to be looking at as well, because if you look at the overall business, they have a tremendous gross margin. It's like 96%. So I'm not going to say this is the highest I've seen. I would say that it's extremely high compared to only a few companies out there. But their R&D expenses last year were over $2.1 billion on $4 billion in sales. So they have a lot of R&D expenses, and that might be indicative of some of the EPS aspects in the miss. But at the same time, they'll probably have to talk about that in their earnings conference call, because I'm sure analysts will be focused on that, because that's essentially encumbering the net income or earnings per share for the business because of those high R&D expenses.
Yeah, certainly a possibility. George, we appreciate you being with us to recap all of this.